Have you ever heard words like the Dow or the S&P 500 and just felt kind of lost? Like you're on the outside of a big conversation everyone else seems to understand? Well, you're in exactly the right place. The stock market, it feels incredibly complex, almost like a secret language just for finance experts. But here's the truth. At its heart, it's built on ideas that are actually pretty simple, ideas that anyone can get. In this explainer, we're going to pull back that curtain. We'll break down everything from what a stock even is to how billions of dollars are zipping around the globe every single day. And by the end, those news headlines won't just make sense. You'll actually understand the powerful engine that's driving our whole modern economy.
You see this all the time, right? It's just a simple little phrase on the news or a website. The market is up today. They say it like it's a fact, like the weather. But which market are they even talking about? And what does up really mean? Is that good for you? Is it good for everybody? This one little phrase is the perfect example of how we talk about the stock market, like it's this single thing with a mood that we should all just get. Or you might hear something with a little more drama, like this one. The Dow dropped 500 points. Okay, this sounds way more specific, it sounds urgent, and honestly, a little bit scary. Your mind just starts racing with questions like, what is the Dow? A company? A building? And why do they measure it in points and not, dollars? A 500-point drop feels huge, but without any context, it's just a big, scary number that leaves you feeling more confused than informed.
And then there's this kind of talk, which can feel like the most exclusive of all. Investors are buying tech stocks. It sounds like there's this group of people out there, the investors, and they're all making these smart moves in a world you're not a part of. It makes the market feel like some kind of private club with its own secret handshakes and strategies. And you're left wondering, well, who are these investors? What do they know that I don't? And what on earth is a tech stock anyway?
And that, right there, brings us to the real question behind all these headlines. What does any of this stuff actually mean? How does this massive global system of numbers and charts really truly work? Who's making the calls and what forces are pushing prices up and down every single second of the day? Our goal today isn't just to give you a bunch of definitions. It's to give you a framework, a real intuitive feel for the market's engine, so you can see it not as some big mystery, but as what it really is, a marketplace.
All right, let's get into it. Here's our roadmap for today. First up, we're going to tackle the big one. What is the market? Then we'll take a quick trip back in time to see where this whole idea came from. After that, we'll get into the nuts and bolts of how a trade actually works, like what happens when you click buy. From there, we'll learn how to decode the numbers you see on the news every day. Then we'll get to the fun part, why prices are always changing. And finally, we'll zoom out to see the market's bigger impact and why it really matters to all of us.
Okay, Section 1. What is the market? Before we can get into the global system, we have to understand the one simple idea it's all built on. It's so easy to picture the stock market as this scary, abstract cloud of data and blinking lights. But at its heart, it's not a mystery. It's really just a marketplace. Seriously, like a farmer's market. But instead of trading apples and carrots, people are trading ownership.
And this right here is the one thing being sold in that marketplace, a stock. The official definition is a share of ownership in a company. So why would a company want to sell off little pieces of itself? Well, to raise money. It's how a business can get cash to grow, to build new factories, hire more people, or invent cool stuff without having to go to a bank for a loan. So when you buy a stock, you're not just buying some number on a screen. You're giving that company your money in exchange for a tiny, real piece of the business itself. Let's just let that sink in for a second. Owning a stock, even just one single share, means you are a part owner. You own a tiny fraction of everything that company has, its buildings, its patents, its brand name, and maybe most importantly, you have a legal claim on a piece of its future profits. So if the company does great, the value of your little piece goes up. If it struggles, well, the value of your piece can go down. You're literally sharing in the company's future, for better or for worse.
This chart does such a great job of showing what we're talking about. Look at that whole circle. That's the entire company. And that tiny little slice? That's your share. You're not just a customer anymore. You are on the same team as thousands, maybe even millions of other owners. That's a huge shift in how you relate to a company. You are now tied to its fate. When you hear a company's stock price went up, it just means the total value of all those little slices just got bigger.
Now, if the idea of owning a tiny slice of some giant global corporation still feels a little abstract, let's shrink it way, way down to something we can all wrap our heads around. A simple lemonade stand.
Okay, so let's walk through this using our lemonade stand as a mini stock market. First, the class needs money for lemons and sugar, right? So the teacher divides ownership of the stand into 100 equal pieces, or shares. Step 2, she sells each share to the students for $1. Boom! The stand now has $100 to get started, and the students who bought in are the new owners. Step 3, the lemonade is a massive hit. The stand is making tons of profit. Now, those little ownership pieces are way more valuable because they represent a claim on a really successful business. That $1 share might be worth $5 now. So, step 4, another student who missed out sees how well the stand is doing and wants in. They offer to buy share from an original owner for $5. If the owner agrees, they've just made a trade. That buying and selling based on the changing value of the lemonade stand, that's the stock market in a nutshell. Now just imagine that on a global scale, and you got the real thing.
So now that we get the concept, where did it even come from? This idea of selling off pieces of a business to fund a huge project wasn't invented yesterday. It's actually a pretty old idea, born out of necessity hundreds of years ago to solve a really big problem. How do you pay for incredibly expensive and risky adventures?
This timeline really shows you the incredible journey of this idea. It all kicked off back in the 1600s with the Dutch East India Company. They wanted to fund these super dangerous, year-long sea voyages to trade for spices. No one person, not even a bank, could afford to risk losing an entire ship. So they had a brilliant idea: sell shares to the public. Hundreds of regular people could each chip in a little bit. If a ship sank, nobody was ruined. But if it came back loaded with valuable spices, everyone shared in the massive profits. That was the birth of the public company. Fast forward about 150 years. In a brand new America, a group of 24 traders met under a buttonwood tree on what we now call Wall Street. They signed a deal to formalize their trading, creating rules to make it more organized. That was the beginning of the New York Stock Exchange. And just look at where we are today. That meeting under a tree has morphed into this global digital network. Millions of trades happen in a blink of an eye, connecting investors from every corner of the planet. It's the same core idea, just supercharged by technology.
So we've covered the what and the why. But what about the how? I mean, in today's world, what actually happens behind the screen when you pull out your phone, open an app, and decide to buy a piece of a company? Let's follow the lightning-fast journey of your order, from your tab to actual ownership.
So the first thing you need to know is that you can't just call up the stock exchange yourself. You need a middleman, a licensed one called a stockbroker. Back in the day, this was literally a person you'd call on the phone. Today, it's almost always a company with a website or an app, like the ones you see here. Think of them as your authorized agent. You open an account with them, put money in it, and they provide the tech and the legal hookup to the actual marketplace where all the trading happens.
Okay, let's walk through these 4 steps because this is the mechanical heart of the whole market. First, you place your order. You log into your app and you decide you want to buy 10 shares of, say, Company X. You hit buy. Second, your broker instantly zaps that order over to a major stock exchange, like the New York Stock Exchange or the NASDAQ. Third, and this is where the magic happens, the exchange is basically a giant high-speed matchmaking computer. It sees your order to buy 10 shares and instantly starts looking for someone else's order to sell 10 shares at that exact same price. And finally, the 4th step, the transfer. Once it finds a match, and we are talking microseconds here, the trade is executed. The deal is done. The money is set to move from your account to the sellers, and the ownership of those shares is officially moved to your name. You are now a stockholder. And this whole process happens millions of times every single second, all day long.
Okay, so now we get how a single trade for a single company works. But that brings us right back to those headlines from the beginning. When a reporter says the market was up today, they can't possibly be talking about every single one of the thousands of companies out there. I mean, some went up and some went down. So what are they actually talking about?
The answer is they're almost always talking about something called a stock market index. An index is basically just a performance snapshot. It's a special list of specific stocks that are grouped together to give us a general vibe of how one part of the market or the whole market is doing. It's a way to see the forest without having to look at every single tree.
Here in the US, there are 3 main indexes you'll hear about all the time. First, you've got the S&P 500. This is probably the most important one. It tracks 500 of the biggest and most influential companies in America, from all different industries. Because it's so broad, a lot of people see it as the best report card for the whole US economy. Then there's the Dow Jones, or just the Dow. This one's the oldest and simplest. It only tracks 30 huge, well-known companies. It's not as complete as the S&P, but people still watch it closely because of its history. And finally, there's the NASDAQ Composite.
This index tracks thousands of stocks that trade on the Nasdaq exchange, and it's famous for being packed with tech companies. So when you hear one of these indexes went up, it just means that on average, the stocks in that particular group had a good day.
This is the absolute perfect analogy for it. You don't need to measure the temperature of every little particle of air to know if it's hot outside, right? You just look at a thermometer. Well, it's the same idea here. You don't need to track thousands of individual stocks to get a sense of the market's health. You can just look at an index, like the S&P 500. It gives you a quick, pretty reliable reading of the market's overall mood and direction.
Now here's another thing that might seem a little strange in our 24/7 world. The stock market basically keeps bankers' hours. The big U.S. exchanges are only open from 9:30 a.m. to 4 p.m. Eastern Time, Monday to Friday, and they're closed on weekends and holidays. This is mostly just a tradition from back when people did all this trading in person on a physical floor, but the schedule actually helps. It concentrates all the buying and selling into a specific window, and it gives companies time after the market closes to release big news, so everyone has a chance to digest it before trading starts again.
But, and this is a really important but, just because the bell rings at 4 p.m. in New York, it doesn't mean the world of finance goes to sleep. Almost every major country has its own stock exchange: London, Tokyo, Shanghai, you name it. And because of time zones, they operate on this rolling schedule. As the trading day is winding down here in the US, the markets in Asia are just waking up and getting started. This creates a nearly non-stop 24-hour cycle of global trading, 5 days a week, with money flowing seamlessly from one continent to the next.
Okay, this brings us to the most exciting and, let's be honest, most confusing part of the market: the constant movement. Prices are never, ever still. They are always ticking up, ticking down, every single second. So what's the fundamental force, the engine that's driving all this change? Well, it all comes down to the single most important idea in all of economics: the constant tug of war between buyers and sellers.
It really is all about supply and demand. Think about it like a live auction. On one side, you've got a situation with more buyers than sellers. Imagine a rare painting goes up for sale, and 10 people are desperate to own it. What happens? They have to outbid each other, right? They push the price up and up and up. That's high demand, and it makes the stock price go up. Now, on the other side, you have the opposite: more sellers than buyers. Imagine 10 people are all trying to sell the exact same used car, but only one person is looking to buy. What do those sellers have to do? They start lowering their price to try and get the sale. That's high supply, and it makes the stock price go down. Every price you see for a stock is simply the result of this constant auction. It's just the very last price where a buyer and a seller agreed to make a deal.
So the obvious next question is, what causes that imbalance? What makes a bunch of people suddenly want to buy or suddenly want to sell? Well, it's a mix of hard facts and human emotion. For instance, a company reports amazing profits. That's great news, and it creates more buyers. Or the government says the whole economy is shrinking. That's bad news, and it creates more sellers. A company unveils some amazing new product, and that can cause a buying frenzy. But sometimes it's not even that concrete. Sometimes it's just a feeling, a collective shift in what investors think is going to happen in the future. That alone can be enough to tip the scales. The stock market is basically a giant information machine, constantly reacting to news, data, and human feelings. And that's why prices are always moving.
This brings us to our final and maybe most important section: the bigger impact. We've talked about all the mechanics, but why should any of this matter to you, especially if you're not an active investor? Well, the stock market isn't just some big casino. It plays a vital, fundamental role in the health and growth of our entire economy.
The market creates this really powerful two-way street that benefits both sides. For companies, it's a key way to raise what's called capital. That's just a fancy word for money. They can sell shares to the public to get the funds they need to grow. And on the other side, for investors, and that includes pretty much anyone with a retirement account like a 401k, it offers a way to participate in that economic growth. It lets regular people become part owners of some of the most successful companies in the world, giving their savings a chance to grow over time.
And we're not talking about abstract financial stuff here. The money that companies raise from selling stock gets used for very real things that push the economy forward. They use it to build new factories, which creates jobs. They use it to hire more employees, from engineers to salespeople. They pour it into research to create new technologies that can literally change our lives. And they use it to expand their businesses all over the world.
So when you strip away all the daily headlines, all the confusing jargon, and those crazy charts, this is really the ultimate takeaway. The stock market is an engine. It's a complicated but ultimately pretty brilliant system for channeling the savings of millions of people to the companies that are out there building the future.
And while its day-to-day moves can feel totally random and chaotic, its long-term purpose is to fund and to reflect the overall growth and innovation of our economy.
So in the end, maybe the best way to think about the market is like a giant global voting machine. But instead of voting with ballots, we all vote with our dollars. Every single trade, every buy and every sell is a little vote based on what millions of people believe a company or an entire industry will be worth down the road. It's a real-time reflection of our collective confidence or our collective worry about what's coming next. Which leaves us with a final, pretty big question to think about. As this engine channels all our collective money, what kind of future are we all together choosing to build?